You trade against powerful players. You don't know who. And that's the problem. Did you know that 97% of all crypto purchases are made with one goal: to sell later at a higher price? That sounds like a Ponzi scheme, but it's not, because the biggest names on Wall Street are part of the same game. That doesn't make it safe, it makes it systemic. To see why that matters, you need to know who's inside and what role they play, what drives them, what limits them, and most importantly, how their actions move the price. In this episode, I'll introduce you to the key market players. I'll show you how they behave, what advantages they have, and how they fit into a larger market ecosystem, like species in an environment or predators in a food chain. And at the end, I'll walk you through two real examples, Ethereum and Bitcoin, where understanding these participants explains everything about the price moves we've seen. Let's begin. You're watching Crypto Holistic, a channel where an engineer shares clear, structured insights into markets, technology, and psychology. No hype, no drama, no parroting the same headlines you've heard everywhere else. The goal here is different: to help you think deeper, connect ideas, and understand what really drives the systems we interact with. I believe complexity can be explained simply, without oversimplifying. So if you're tired of surface-level noise, you're in the right place. This content is for educational purposes only. It's not financial advice. Retail participants are individual actors, people trading with their own money, without institutional structure or oversight. They operate with limited capital. That means they can enter and exit positions quickly without moving the price. Retail reacts fast, sometimes too fast, driven by news, fear, or hype. They rarely access private rounds, but often they show up early in public markets, just before the institutions arrive. Retail moves quickly, but not always wisely. Emotion drives action more than strategy. Individually, they don't move markets, but together they can cause surprises. Many chase short-term wins. Some hold for months, or even years, usually by accident. Retail often lacks a plan. Stop losses, position sizing, and exits are improvised on the fly. Their limits are technical, not institutional. They face platform outages, slippage, high fees. They trade to make money, to escape their jobs, or just for the thrill. Retail can go anywhere, buy anything, and change direction in a heartbeat. They sell too soon, buy too late, and often need cash, exactly when the market turns against them. They don't compete head-to-head, but they're the easiest to outplay. Their footprints are easy to spot. Late entries, early exits, volume spikes at extremes. Think Wall Street bets, Robinhood traders, or your cousin who got into crypto in 2021. Retail flocks to stories, memes, and momentum, often with poor timing. If you had to picture them in nature, they'd be the hare. Fast, nervous, and always ready to run. Agile but exposed, quick to react, yet easy to trap. A herd of hares darting across a landscape shaped by giants. When the wind shifts, they scatter. But sometimes, they lead the stampede. Hedge funds were originally created to hedge risk, but today the name feels almost ironic. Modern hedge funds are aggressive, fast-moving, and fiercely competitive. They operate with massive capital, enough to move the market if they're not careful. That's why they split orders, use dark pools, and route through complex systems to hide their intent. They often enter just after insiders and VCs. That makes them early movers in public markets, but still behind the real first wave. They're fast, but not impulsive. Execution desks, quants, and strategy teams coordinate every move. Their goal is absolute return. Make money regardless of direction. Bull market, bear market, sideways. Doesn't matter. They rely on advanced tools, algorithms, models, and risk systems based on VAR. It's precision over intuition, systems over stories. But they're not invincible. When too many hedge funds crowd the same setup, things break. Liquidity vanishes. Exits turn into traps. That's why they prefer deep, tradable markets. They stay away from small, illiquid projects. Not enough room to move. On the chart, hedge funds leave sharp traces. Breakouts, fakeouts, sudden fades, moves that retail often misreads. If the price whips up and reverses fast, it's probably them. They don't wait for confirmation. They create confirmation. If hedge funds were animals, they'd be big cats, tigers, panthers, jaguars, each hunting in silence, each with its own method. They don't move in herds. They stalk, they strike, and they compete, not just with the market, but with each other. One hunts the breakout, another ambushes the pullback. All of them watch the same prey, and sometimes one eats while the others starve. Fast, strategic, dangerous. They are the apex predators of the financial jungle. Market makers don't bet on direction. They profit from spread, the small difference between bid and ask. Their job is to provide liquidity, to be available on both sides of every trade. When you want to buy, they're selling. When you want to sell, they're buying. They use high-speed infrastructure, low-latency servers, co-located data centers, smart order routing. Their edge is execution, not opinion. They don't care where the price goes, as long as it goes somewhere. Market makers enable movement. Without them, every trade would need a counterparty, manually. They reduce slippage, tighten spreads, and keep markets fluid. But they also exploit emotion. They know when traders are desperate, and they fill that desperation at a premium. They fade strength, buy weakness, and adjust faster than any human ever could. You don't compete with them, you trade through them. They don't hunt, they circulate. In our ecosystem metaphor, market makers are like photosynthesis and respiration. Plants take in sunlight, they store energy, and release oxygen. Animals breathe in that oxygen to release energy from food. One transforms input into output. The other unlocks that output into usable energy. Market makers do the same for capital. They move liquidity from those who put money into the system to those trying to take it out. They're not predators. They're not prey. They are the circulation system of the financial biosphere. As you watch these profiles, keep in mind, we'll soon look at how they all come together on real Ethereum and Bitcoin charts. Venture capital firms and angel investors operate in the shadows of early innovation. They fund ideas before the public even knows they exist. Their capital stays locked for years, but their influence can shape entire ecosystems. They enter first, but they exit late. And when they do, retail often holds the bag. These players aren't fast, they're not liquid, but they hold a unique edge: access. By the time a project hits public markets, much of the supply is already in their hands. When token unlocks arrive, their selling can trigger dramatic price shifts, often surprising newcomers who never saw it coming. Their weakness is patience. Their strength is positioning. And when their time to sell arrives, the chart speaks for itself. In our ecosystem metaphor, they are the seeds. Most will never grow into mature trees, but they colonize empty ground where nothing existed before, and within them lies the potential for something extraordinary. Asset managers like BlackRock and Vanguard don't trade for themselves. They manage massive amounts of money on behalf of pension funds, governments, and retail investors. Their job isn't to buy low and sell high, because there's no one above them to sell to. They are often the final buyer in the chain. They invest based on mandate, not conviction. They must allocate capital consistently, passively, predictably, and because of their sheer size, their steady flows can reshape entire markets without anyone noticing. But here's the kicker. Assets often go up simply because they're buying them, not because of innovation, not because of earnings, but because the biggest players are legally obligated to keep pouring money in. This creates a feedback loop. New investor money comes in. Funds must allocate it quickly. They buy the same assets as before. Prices rise. Performance looks good. More capital flows in. Dividends and passive income help reinforce the illusion of value. Meanwhile, asset managers charge fees on everything they touch, regardless of outcome. But there's a hidden cost to their scale. They can't just exit a position overnight. They're too big. If they try to sell, they become the market. Liquidity disappears, prices drop, and their own exit hurts them. That's why they avoid small cap assets entirely. A billion-dollar fund has no reason to study a company worth 50 million. Even if it triples, it barely moves the needle. They don't look for hidden gems. They wait for things to become large and expensive before they step in. In the financial ecosystem, asset managers are like industrial agriculture. They don't hunt for profit. They engineer predictable growth. They turn markets into monocultures, prioritizing scale and compliance over innovation. They reshape the entire environment, and everyone else has to adapt. They're not predators. They're system operators. And when they choose an asset, it doesn't grow because it's good. It grows because it was chosen. They invest for strategic positioning, to hedge inflation, support future suppliers, expand their ecosystem, or gain influence over critical technologies. Sometimes it's about acquiring potential partners before they become competitors. Sometimes it's about placing early bets on infrastructure they'll later depend on. Unlike hedge funds or traders, they don't respond to market signals. They follow internal roadmaps shaped by board decisions, legal teams, and multi-year goals. Retail traders can't predict their moves by watching charts. But if you follow corporate filings, partnerships, patents, and M&A activity, you might get early signals. These players often buy quietly, but when it's time to announce, they make headlines, shifting public sentiment overnight. And just like a silverback gorilla leads and protects its group, corporations often acquire smaller firms, then manage them as part of a coordinated strategy. The gorilla doesn't hunt. It builds, shelters, and dominates by design, not speed. In the financial ecosystem, they are slow, deliberate forces, not driven by fear or greed, but by vision and structure. And when they don't move alone. They reshape the jungle to serve their long-term goals. We're almost ready to put all this into practice and see how these players shape the actual Bitcoin chart. They don't trade, but they define the game. Governments and regulators are not market participants in the traditional sense. They don't enter positions or manage portfolios. Instead, they shape the playing field just through laws, monetary policy, and enforcement. Their capital scale is immense, but it's used to manage economies, not to chase profit. Whether it's defending a currency, bailing out a bank, or launching a central bank digital currency, their influence is unmatched. They move slowly, through legislation, committees, international treaties. Their actions are deliberate, often taking months or years to implement. But once they act, the effects are long-lasting. They typically enter markets late, or only in moments of crisis. You won't see them front-running trends, but you might see them banning assets, issuing sanctions, or regulating entire sectors out of existence. Their reaction speed is bureaucratic by nature. It's not about milliseconds. It's about process, precedent, and politics. And yet, their market impact is enormous. A single interest rate decision or regulatory change can create new trends, kill old ones, or redefine risk across the globe. They operate on a long time horizon. Their goals are measured in decades, maintaining national stability, steering economies, preserving strategic advantage. Their risk isn't financial. It's geopolitical. A misstep can lead to inflation, unemployment, or a loss of public trust. Their constraints are heavy. Constitutions, laws, voters, global alliances. They can't pivot like hedge funds or retail traders. Every move is a negotiation, but their tools are powerful. Printing money, changing interest rates, enforcing legal mandates. Tools that give them a kind of control no other group has. Still, they're vulnerable. To lobbying, to short-term political incentives, to public opinion. Their decisions are rarely pure strategy. They're often a compromise. In the grand scheme, they compete systemically. Nation against nation, model against model. On the chart, their fingerprints show up as abrupt shifts, new volatility regimes, structural breaks, sudden gaps. You may not see them enter a trade, but when they act, the entire market listens. That's why understanding their power and their limits is essential. They are not predators. They are not prey. They are the seasons. Now let's move from theory to practice. It's time to see how real market behavior, from accumulation to distribution, actually plays out on the chart. Let's take a closer look at Ethereum's historical chart. Not just the price, but the underlying behavior of market participants. We begin on the left side in the first accumulation phase, marked as A. Price action is still flat, but volume activity starts to increase. You can also see my indicator below the chart. It begins to slope upward. That's a sign of growing involvement. Quiet accumulation by smart money. Then comes the first breakout. Price climbs over 16 times and quickly transitions into a classic distribution. Marked D. Price peaks sharply, but look what happens with the indicator. It turns downward. That's not a bug. That's the whole point. Distribution isn't about selling everything in one day. It's a slow process. The indicator confirms that long-term participants are no longer accumulating. They're unloading. Next, we enter a long reaccumulation phase. A to re-A. Many people get bored or scared off here. But those with a deeper understanding can recognize it. Low volatility, modest price gains, large volume. That's smart money re-entering. And again, the indicator confirms it. Slow, steady growth from left to right. Then comes MU, markup. Price explodes almost 35 times. But notice the change. Now, small volumes cause huge price jumps. Why? Because the goal isn't to buy. It's to trigger emotion. This is where traders, risk takers, and eventually late retail enter. If the project is strong, you'll also see institutional money joining at higher prices. Because for them, liquidity matters more than entry price. After the markup, we see distribution again. Not once, but multiple waves of it. The indicator flattens. It no longer rises, and at some points it barely registers activity. That's the hallmark of distribution. Weak holders enter, but the big players are already out or patiently waiting. No more accumulation means no fuel for another rally, at least not yet. And this is the true value of this custom indicator. It helps us differentiate real accumulation from fake ones. It reveals whether participants are truly committing capital or just trading noise. Because in the end, price alone is not enough. To understand where the market is going, you have to understand who is behind the moves and how they operate. Bitcoin, accumulation, distribution, and my theory. Now let's turn to the Bitcoin chart. And again, we'll go beyond the price. This is not about guessing tops and bottoms. It's about recognizing behavior. Just like we saw with Ethereum, price movement alone is not enough. We need to understand who is behind the move and why. We begin on the left, accumulation phase A. Price is flat. Volume is unremarkable. But my custom indicator starts to rise slowly. That's a quiet signal. Smart money is buying. Then comes RA, reaccumulation. And shortly after, a powerful breakout followed by distribution. You'll see multiple waves of D. The price goes up, and volume supports it. But notice the indicator. It flattens. That tells us large players are reducing positions. They're not in a rush. That's how professionals operate, like in reminiscences of a stock operator. I made my money by sitting, not by thinking. They don't chase. They exit methodically. Then something very interesting happens. We hit SA, super accumulation. What makes it super? The answer might lie in my theory. And yes, this is my own analysis, not something I read on Twitter. Around that time, Binance quietly enabled fee-free or ultra-low-fee trading for selected high-frequency players. What does that mean? It means accumulation became easier. You could build a massive position, Mike, without alerting the market. No one's watching a million micro trades at zero fee. That's the perfect camouflage. Whether or not my theory is fully correct, it fits the data. Volume spikes. The indicator rises strongly. Price barely moves. That's textbook accumulation, but done at scale. Then comes MU, markup. The price accelerates. Small volumes push it higher. The hard work is done. This is the moment of release. Now come the late traders, the swing players, the emotional crowd. And again, distribution. We see two clear waves of D. The indicator goes flat. Price still holds high, but the buyers are no longer long-term. There's no more fuel. If you're wondering why price moves sometimes and why it doesn't other times, I strongly encourage you to watch my full-length episodes in the series. What moves the price? There's a deeper logic to all of this, and once you see it, you can't unsee it. What you've just seen in those last two charts is a kind of market analysis you don't usually find on YouTube. Not just price predictions, but actual behavior. Mapped, interpreted, decoded. Because understanding who you're trading against, their strategies, budgets, and timelines brings you much closer to understanding the price itself. Ethereum, Bitcoin. Different patterns, same logic. Once you see it, you can't unsee it. And here's the thing. This is just the beginning. In the next episodes, we'll go deeper into structure, manipulation, technical setups, and how to read signals with clarity. The kind of clarity that comes from logic, not noise. As retail participants, we're not powerless. We're part of the ecosystem. And if we understand the system we're in, we can adapt, position, and survive. One strategy at a time, one insight at a time. Thanks for watching. This is Crypto Holistic.